Good morning, everyone. Thank you for being here bright and early for this session. I can't think of anything, Lee, that would be more stimulating way to wake up than talking about the financial crisis. 10 years on, this is obviously something that 10 years ago all of us were very, very conscious and was front and center. Lots of things have changed in the world, but in many ways, lots of things have not changed, and so it's a very salient and live topic. The stock market has been booming in recent months and recent years, and if you look at the headlines on any given day, they are constantly asking the question whether the next hit will come any day now. And so thinking about what the appropriate regulatory regime is and what we learned and didn't learn, as the case may be, from the financial crisis is really an important topic and an appropriate one for us to be discussing here. It is obviously the case that we can all acknowledge that the regulatory response to the financial crisis was fairly substantial and far-reaching. Whether it was effective, obviously, is a different question, and one that we'll be engaging at a number of levels today. We have three great panelists. As those of you who follow the program closely know, we lost two of our panelists, but we gained one. I think Boston can hold this over New York, that apparently a bomb cyclone is enough to scare away two New Yorkers, but a Bostonian had no problem getting through it. So one more point for Boston, I suppose. It could be an Australian too, sort of helps that's whatever, good constitution from Boston. So we're particularly glad to have Hilary Allen here from Suffolk Law School, who joined the panel with about 20 minutes notice. And yet I think will still deliver for us some great thoughts and reflections on this. She writes on financial stability, as well as systemic risk, particularly in banking, but also more generally. She'll be speaking this morning about the FSOC, and how it has evolved and its impact in the time since the financial crisis. Todd Zywicki from George Mason Law School, obviously again another expert on this subject that many of you know, will be speaking on the Cfpb, obviously an institution that arose out of the response to the financial crisis, and one that has represents a fairly substantial shift and significant adjustment to the landscape of financial regulation in the United States, but one who remains an uncertain. It's a big question mark about what its future holds, not just in the context of leadership changes, but also because its fundamental mission is open to some question as to its viability and the rigor it brings to it and the like. Finally, David Zaring will be speaking on a number of issues related to the post-crisis response, and thinking about whether we have been over-regulating, under-regulating, and how effective our regulatory response has been. I think we'll get a range of views on efficacy, both at the level of individual institutions and more generally. We'll get, I hope, some perspective on international responses as well. And collectively, I think we'll all be much wiser at the end. So let me start with Todd and ask Todd to get us started, and then we'll proceed down the line. And we should have ample, particularly given the reduction in panels, we should have ample time for questions and answers. So be prepared to join the discussion. Please, Todd.
Sounds good. Good morning. I'm not going to rehash a lot of the financial crisis. It is funny, though, to think about as we gather here. And for those of us, as Bobby was talking about, who've been around, to me, it still seems like it was just yesterday, right? And I'll be like in class, and I'll make an offhand reference to the financial crisis to my students. And I was like, oh, yeah, you guys were in middle school. It's like, let me explain what that was. Let me tell you the auto bailouts, what that means, right? I mean, it's just kind of an amazing thing of how the world turns. So what I'm going to talk about is Dodd-Frank with a particular focus on CFPB. I'll say a few other words since our other panelists didn't make it. So I can't, avoid a shot, the opportunity to take shots at other parts of Dodd-Frank, if I've got the opportunity. So since, basically after the financial crisis, we had one of the greatest regulatory onslaughts in history after the financial crisis, right? 2,400, Dodd-Frank was 2,400 pages long, tens of thousands of pages of regulation, tens of billions of dollars of compliance cost in terms of paperwork and the like, and huge economic effects that we did. Let me just ask a question at the outset. Dodd-Frank was supposed to do one thing All those 2,400 pages, 10,000 pages of regulations and costs was supposed to do what? One thing, if nothing else. Get rid of too big to fail and bank bailouts. How many people here think Dodd-Frank got rid of too big to fail and bank bailouts forever? It's kind of an amazing thing to think about, right? And you're not the only ones. I've been traveling the country talking on this for years. I've asked that question to hundreds, if not thousands of people. And the only person who ever raised his hand was some smart aleck at West Virginia University who said that he thought it was. Nobody thinks Dodd-Frank did what it was supposed to do, right? And as we'll see, there's good reason to believe that. Markets don't believe it either, right? But when you think about a regulatory apparatus that was supposed to do one thing and nobody thinks it did it. And the reason, of course, is not because it couldn't work in theory, but nobody believes it's ever going to actually be tried in practice, right? That when the rubber hits the road, there's no reason to believe that those making the decisions are going to test the economy on this completely unproven, untried systems that they have of orderly liquidation authority and that sort of thing. And that creates a real problem, right? When you've got a world in which people don't believe that the legal regime that is in practice is actually likely to be what ends up prevailing. But I think that says a lot about Dodd-Frank generally. These are just some of the regulations that came about. And I think what's been most tragic, and I'm going to focus on most of the consumer stuff, so most tragic is that the post-crisis regulatory onslaught has been most painful and punishing for low-income consumers. And for smaller banks, and it's basically had the unintended consequence of doing exactly what it wasn't supposed to do, which is that the Dodd-Frank regime and everything else has tended to promote consolidation. Bigger banks have gotten bigger. Smaller banks have been disappearing. Smaller banks have been exiting markets. And the other thing we've seen is that we've actually prompted a migration of things like mortgages out of the standard banking system into less regulated lenders. And so basically the Dodd-Frank and everything else has been almost a perfect paradigm example of unintended consequences in action. So let's start with credit cards. So this is the Credit Card Act of 2009. It's a good example. It's not part of Dodd-Frank, it was passed separately. And what this shows is, so what the Credit Card Act did was it interfered with the ability of banks to price risk accurately, and in particular, to change people's interest rates and the like when their credit worthiness changed or when their risk profile changed. What was the impact of that? And so, for example, it's much more difficult to raise interest rates when people, after they start exhibiting risky behavior like late payments and that sort of thing. What was the impact? Well, the first thing we know is because they couldn't adjust interest rates ex post after the fact, what happened? Credit card issuers just increased people's interest rates before the fact, right? Because you always can cut interest rates, you just can't raise them, right? But by also interfering with the ability to price risk and impose penalties and that sort of thing, who did that impact the most? So if you look at this chart here, the blue line or the yellow line, the yellow line are people like us, right? Upper middle class type people. It's basically had no impact on us. The bottom line is the lowest quintile of consumers and households in the economy. What we see is they already had less access to credit cards. And since the Credit Card Act, which was passed in 2009, but Federal Reserve regulations were enacted in 2008 and anticipated in 2007, low-income consumers had an 11 percentage point drop in their access to credit cards. So we've taken away credit cards from low-income consumers. And these are just some quotes and some other research that supports that, right? If you can't price risk accurately, you can only do one of two things. You either lend less to people like risky borrowers, or you lend less to everybody. That's what we saw as a result of the Credit Card Act. They slashed credit lines on credit cards and dramatically reduced access of credit to low-income consumers. A second issue was the Durbin Amendment. The Durbin Amendment was in the Dodd-Frank regulation, and it placed price controls on interchange fees on debit cards, which is the fee that is paid to your bank when you swipe your credit card, say at the Target or 7-Eleven or whatever. And this is just one snapshot of the change, according to the Federal Reserve, the change in average interchange fees for Durbinized and non-Durbinized bank, right, called the Durbin Amendment after Dick Durbin, who put it on last second. What we see is it basically cut in half the interchange fee for debit cards issued by large banks. Any bank over $10 billion was subject to the Durbin Amendment. The blue line is unregulated banks, smaller banks below $10 billion. What was the impact of that? So that was part of Dodd-Frank. Since that time, what we've seen is that free checking, again, this is an issue that's of particular interest to low-income consumers. Free checking had soared as a result of the introduction of debit cards during the early 2000s. And from about 2000 to 2009, free checking went from less than 10% to about 76% of bank accounts had access to free checking. After the Durbin Amendment was passed, what did banks do? Once they lost the interchange fees, and basically Durbin Amendment turns debit cards into a loss center rather than a profit center, because it only allows the banks to charge the incremental cost of transactions, not the overall cost of operating. What they do, they passed on the losses to consumers in the form of higher bank fees and a reduction of access to free checking. Since the Durbin Amendment went into effect, free checking has been cut in half for consumers. And again, who was it who lost access to free checking? Not you and I. It was lower income consumers. The rest of us just adjusted by increasing our minimum balances or by consuming other bank services, all of which preserve free checking for us. Low income consumers couldn't do that. They basically ended up having to pay higher bank fees. See if you can guess, looking at this chart, when the Durbin Amendment was passed. I know we're not all economists here, but you can see mid-2017, July is when Dodd-Frank was passed, including the Durbin Amendment. This is the average fee on bank accounts, right? Bank account, the monthly maintenance fee doubled. So what we saw was a reduction in access to free checking and a doubling of the fees for those who didn't have access to free checking. What was the overall effect? This dramatically contributed to increase in unbanked consumers. It's not clear how many. It may have been maybe as many as 1 million consumers who had bank accounts, lost bank accounts. And what else do we see? A dramatic increase in alternative products uses like pawn shops, prepaid cards, payday lenders, things like that. Low-income consumers also lost access to debit rewards, right? So credit cards have become more and more aggressive about giving us more and more generous rewards. Because of the Durbin Amendment, though, a lot of lower income consumers used to get rewards from their debit cards, and the first thing they did was phase out debit rewards, right? So what do we see here? We see they've taken away credit cards, they've taken away bank accounts, and this has fallen heaviest on low income consumers. What about mortgages? They were going to take care of mortgages also, because that's what caused the financial crisis, right? Qualified mortgages and the ability to repay rule. We put in these very strict underwriting guidelines that are basically one-size-fits-all regulations, limited what kind of fees you could charge, and that sort of thing, right? What was the overall impact of that? Which is, well, again, what we see is that the top end of the housing market is largely recovered because of mortgages. Jumbo mortgages continue to be widely available and quite plentiful. The low end of the housing market, though, has had a very different view. The low end of the housing market has yet to recover. Lower income and higher risk consumers are still unable to get access to mortgages. The Diacunto and Rossi articles are particularly a good one where they look at this, and basically what they say is because of the one-size-fits-all regulations and cost restrictions in Dodd-Frank, it basically makes it cost prohibitive to make mortgages of, say, $150,000, right? Because there's a certain fixed amount of cost that's needed to make a mortgage. You could spread that cost over a $500,000 mortgage easier than you could spread that cost over a $100,000 mortgage. Does that make sense? So basically what's happened is they've made it impossible to economically make mortgage loans to low-income consumers. So the high end of the market is recovered. The low end of the market has not, and low-income consumers continue to get have trouble getting access to credit. The other irony of this is that the ability to repay rules and the like, and qualified mortgage rules, there's no evidence that if those had been on the books, that they would have done anything at all to have prevented the mortgage crisis. Why? Well, the primary cause, I mean, there was some fraud and that sort of thing, but the primary reason why the economy fell apart and mortgages exploded was not an ability to repay problem. It was a deterioration of down payments and skin in the game for consumers, which is that what caused it to happen, what caused it to be such a big problem was consumers responding rationally when their houses fell in value, they were underwater, and consumers walked away from their mortgages. Dodd-Frank does nothing about that. All it does is it pretends like everything is an ability to repay problem, when in fact the underlying problem was really a problem of, did you have an adequate down payment? Did you retain your equity in your house and that sort of thing? And the incentives underlying whether or not to walk away, right? Since it does nothing about that, in fact, it actually does nothing about addressing the problems that led to the foreclosure crisis to get so problematic, right? And so the underlying effect of all this is that we've layered on a huge amount of cost. We've harmed low-income consumers in particular, and we've done nothing to actually increase the stability of the system because they had a theory about why foreclosures happened. And as I said, what that's led to is consumers basically shifting to payday lenders, pawn shops, prepaid cards, and the like, as they've increasingly been squeezed out of the mainstream banking system by Dodd-Frank. All right. And now, of course, the latest thing is that the Cfpb is going to ban payday loans, right? Now that basically consumers have turned to payday loans as a lifeline, demand for payday loans is increased because consumers don't have access to other credit products. That's the life raft, and now the CFPB wants to shoot holes in the life raft and tell them to swim, basically, right? And that sort of shows how this goes. But there's larger systemic problems, right, which is Dodd-Frank has been terrible for small banks, that basically the nature of financial regulation, and at least the way it's been applied, is that a lot of the costs do not scale with size, paperwork costs and that sort of thing. So what that means is proportionally, the costs of Dodd-Frank fall much heavier on small banks, right? And so what we've seen in a number of studies is, for example, there's a widely cited Kennedy School study that said that the asset base of small banks has been shrinking twice the size post-Dodd-Frank as it was pre-Dodd-Frank. What you've seen is that small banks, because of the regulatory cost, have been shrinking. They've been merging. They've been exiting markets, such as the mortgage market, where the cost of and risks are too high. And so basically what we've done is driven small banks out, who are supposed to be the good guys, out of the financial crisis. And again, like I said, made the big banks larger and even bigger, too bigger to fail, I guess would be the case, right? The other half of this is, who does most of the small business lending in the country? Small banks, community banks. So as we've been crushing community banks with Dodd-Frank and financial regulation, we've also been crushing small businesses. As you might know, I think it was 3 years ago, for the first time in recorded American history, more businesses died than were started in the United States. And basically what we've seen is, as community banks have disappeared, the small business lending functions that they serve and the agricultural lending functions that they serve have retrenched as well. And so that's what's dampened economic recovery and held back economic recovery. These are just some quotes. Jamie Dimon of Chase had sort of the most famous line about this when he said that Dodd-Frank has, quote, widened the moat, unquote, between the large banks and the small banks, creating more protection for the large banks against competition from from small banks. And so small businesses have been unable to find access. Finally, the other interesting thing is, if you look at mortgages, for example, what has happened? But as we've layered on all these regulations on banks, what have they done? It's become too risky, too unaffordable for them to operate in mortgage markets, especially in low-income markets. And what's happened? Non-bank lenders have stepped in. So basically what we've done is taken the business all the way over to exactly the institutions we were most concerned about. Now, I'm not saying these guys are bad, like Quicken Loans and that sort of thing. But what I am saying is they make over half of the mortgage loans now in the United States, basically because we've driven traditional financial institutions out of this. And so what we've done is actually shifted mortgage lending back to exactly where it was before Dodd-Frank, which is non-bank lenders making most of the mortgages. Right? Another classic example of unintended consequences. And they're meeting a market demand, no doubt, but it's quite an irony if the impact of Dodd-Frank was to actually increase that. I'll say the last thing I'll say, and then I'll sit down, is about too big to fail and some of the other things. As I said at the outset, nobody believes that Dodd-Frank got rid of too big to fail. There's very few things that Jeb Hensarling and Elizabeth Warren agree on. One of them is that Dodd-Frank didn't get rid of too big to fail. Studies tend to suggest that it did not get rid of too big to fail. The market expectations are that there is still a too big to fail subsidy. The GAO did a study where they said it looks like it may have shrunk, but it hasn't disappeared. The IMF did a study where they concluded there was still a too big to fail subsidy that implied an implicit government guarantee. And so after all of this, we've basically ended up with a too big to fail subsidy. I'll close on the last thing, which is just sort of my thoughts on CFPB, and I can go into this more in the discussion if you want. Thinking about CFPB and the like, and what it might look like under the Trump administration. I think if you want to summarize sort of the overarching principles of the Trump administration, especially when it comes to the administrative state, I think it can summarize as basically restoring economic prosperity and the rule of law, right? Which is getting rid of wasteful and job-killing and economy-killing regulations and trying to have more sense and more cost-benefit analysis, but also restoring the rule of law and bringing more formal rulemaking and the like to the things that they're doing, regardless of the agency. I could identify 5 pillars of CFPB reform: innovation, inclusion, choice, competition, and respect. Right? These would be sort of 5 ideas for a vision for a more market-friendly, innovative, proactive, positive agenda for a better financial regulatory system that would promote consumer choice, treat small banks fairly, create a level playing field for non-bank and bank lenders, restore the rule of law through more orderly processes and the like. And I could talk about that more in the Q&A, but for now I'll just yield the podium.
Sure, and actually I'm not going to take the podium. My computer's here, so I hope you don't mind if I speak from here. So I too agree with Jeb Hensarling and Elizabeth Warren that too big to fail has not been ended, but I do think that Dodd-Frank, although imperfect, has made some contributions that make it less likely that institutions will fail in the first place and therefore need a bailout. So what I'm going to talk about today is one of the causes of the financial crisis, perhaps not one that's sort of as explored as some of the others, but that's this concept of silo mentality. The idea that we're in the United States, we have this very fragmented financial regulatory architecture, and we talked about sort of the international context. Well, this is an aspect in which the US is very different from most countries. Most countries have 1, 2, 3 financial regulators. I literally don't know how many financial regulators we have in the United States, and that causes a lot of problems of communication. Each particular regulator tends to focus on their own frame of reference, and that is not particularly helpful if you're worried about risks that are communicated across the entire financial system. So one, but by no means the only manifestation of this silo mentality, was the ignorance of the risks that were growing in the shadow banking area in the lead up to the financial crisis. So the banking regulators, of which we have many state banking regulators, then in addition at the federal level we have the OCC, the FDIC, the Federal Reserve. They were focused on the solvency of individual banks, but they weren't necessarily thinking about how the functions of banks were being mimicked in other parts of the financial system, either completely unregulated or regulated by other regulators like the SEC, who were not necessarily focused on the same kinds of issues as the banking regulators. So one of the issues that the Dodd-Frank creators were trying to deal with was, okay, how can we potentially address this silo mentality? How can we start to improve communication between the different regulators so that they let each other know what's developing in the area, what they're seeing, what the risks are, and how can we get them to talk about it? So there are many different ways that you could address that. As I said, many different countries instead just have a few regulators, and it's much easier to get them to coordinate. And regulatory consolidation has been a priority for every administration, including the Trump administration, going back decades and decades and decades. I just don't see it happening from a political perspective. I would like to see it. I would like to see us having fewer financial regulatory agencies, but I just don't think it's on the cards. So given that political reality that we're not going to consolidate the number of regulatory agencies, what can we do to improve communication between them? And so what they came up with as part of Dodd-Frank was the creation of the FSOC, the Financial Stability Oversight Council. And Ben Bernanke described the purpose of the FSOC. He mentioned that the broad membership of the council is intended to limit the tendency of regulators to focus narrowly on the institutions and markets within their jurisdictions while overlooking risks from interdependencies that cut across jurisdictions. So this was really one of the motivating forces behind the creation of the FSOC, was to break down this silo mentality. For those of you unfamiliar with it, I'm going to give you just some background on what exactly the FSOC is. It's a council. It's comprised of the chairman of the Federal Reserve, the comptroller of the currency, the chairperson of the FDIC, the director of the Cfpb, the chair of the SEC, the chair of the CFTC, the director of the Federal Housing Finance Agency, and the chairman of the National Credit Union Administration Board. In addition, and I think this is important, there is insurance representation on the FSOC, notwithstanding that insurance is only regulated at the state level. There is an independent member appointed by the president by and with the advice and consent of the Senate, having insurance expertise, who serves on the FSOC. And so that, again, sort of breaks down, insurance in particular was excluded from conversations at the federal level about risks that were growing. So this is an important innovation, bringing insurance representation onto the FSOC. And then there is the Treasury Secretary, who is not only a voting member, but also the chair of the FSOC. The FSOC also has 5 non-voting members, the director of the Office of Financial Research, director of the Federal Insurance Office, as well as representative state banking, insurance, and securities commissioners. So perhaps the best known power of the FSOC is its power to designate non-bank institutions as systemically important and therefore subject them to regulation by the Federal Reserve. In addition, the FSOC has the power to designate financial market utilities, so these are sort of clearing settlement organizations, and bring them again under the power of the supervision of the Federal Reserve. I think these are the powers for which the FSOC is best known. And these are sort of the political hot potatoes or lightning rods that tend to attract attention. But the FSOC also has some lesser-known powers and functions that I think are really important in terms of this sort of breaking down this silo mentality. So these include, scrolling down, there is a requirement that the FSOC meet at least quarterly. So these people actually have to get together and come into a room and talk about issues that they're seeing at least quarterly. They're required to publish an annual report which identifies potential threats to financial stability, so they have to commit to writing the things that they're concerned about. And I like these reports. They come out annually. I think they provide a lot of good information about what's going on in the financial system. The Secretary of Treasury has to testify to Congress regularly, at least annually, about what's going on in the financial system in terms of systemic risk, in terms of threats to financial stability. And in addition to those sort of communication and coordination provisions, there's also some interesting provisions where the FSOC has some powers over the actual regulatory agencies themselves, and these are not particularly well known. Section 119 of Dodd-Frank allows the FSOC to resolve with a non-binding recommendation disputes against other agencies. Now, this hasn't really been put to the test, but it's an interesting concept. Section 1023 allows the FSOC to invalidate any rulemaking made by the Cfpb that the FSOC determines threatening to stability. So for those who are concerned about the Consumer Financial Protection Bureau inadvertently causing problems to stability, there is actually a mechanism built into the FSOC that it can overturn those rules with a 2/3 vote. There's a provision that allows the FSOC to request, albeit not to compel, information from individual agencies if the communication is not sort of as forthcoming as the other members would like. And then there's a power that has drawn more attention, the Section 120 power, which allows the FSOC to make recommendations to an agency to apply new or heightened standards and safeguards to a financial activity or practice. So if, again, 2/3 of the members of the FSOC feel concerned that a particular agency is sort of asleep at the wheel with regards to a particular type of systemic risk growing in their jurisdiction, the FSOC can actually take steps to make a recommendation. This has only been done once in the context of mutual funds, money market mutual funds. So that sort of resolved itself. It's a very long story, but basically in the end, the SEC decided to mostly do what it was going to do anyway, but the FSOC sort of reserved its right to require more stringent action in the future if it felt it was needed. But that power is there. So what we have with the FSOC is not just a body responsible for designating firms as subject to heightened supervision by the Federal Reserve. We have a body that has a lot of different types of mechanisms designed to coordinate responses from the regulatory agencies to promote communication between those entities in an attempt to address this silo mentality that can be so dangerous to financial stability. Now, whilst I sort of am a proponent of the FSOC, I do not by any means think it's perfect. I think it's very much a second best solution. As I said, I would have liked to have seen consolidation of the federal regulatory agencies. I don't think that's going to happen. Even if we're going to just have a council of regulators, it's not as perfect as it could be. It has no significant staff or resources of its own. So as a result, it's forced to rely on its component agencies in advancing its mission of promoting financial stability. And whilst the FSOC itself has a financial stability mandate, those individual component agencies, none of them have an express financial stability mandate. I've made arguments that they potentially have implicit financial stability mandates, but they don't have express ones, right? So you have this odd situation where you have a council that is meant to be leveraging the expertise of individual agencies to promote financial stability, but none of those individual agencies are necessarily legally committed towards promoting financial stability. So it's definitely, as I said, less than perfect. But despite its shortcomings, the FSOC remains the only United States agency that is expressly committed to promoting financial stability. And so I think in that sense, we have to do the best with what we have. And it has had some positive effects. So in a 2016 GAO report, it was noted that the member agencies of the FSOC generally stated that participation in the Systemic Risk Committee, so the FSOC has committees, including a Systemic Risk Committee. So they stated that participation in the Systemic Risk Committee and other FSOC activities helped them build informal communication channels and good working relationships among staff across the agencies, which was not always common before the creation of the FSOC and its committee. So it does sound like there is perhaps not huge, but some progress in terms of breaking down these silo mentalities as a result of the creation of the FSOC. And I'm concerned that the desire by this administration to diffuse the designation issue, I said that that's the sort of what most people think of when they think of the FSOC. They think of its power to designate financial institutions as subject to further supervision by the Federal Reserve. And there's a real desire to diffuse that designation issue, and I'm concerned that those kind of attempts will actually diffuse the other functions of the FSOC that get less attention. And by that I mean, the promotion of communication and cooperation. The Treasury has the power, really. Because of the way the FSOC is designed, the Treasury has the power to very much shift the focus of the FSOC without really any legislative change. The Treasury Secretary is responsible for setting the agenda of any meeting of the FSOC, and also the Treasury Secretary is the person that testifies before Congress for the FSOC. So if the Treasury Secretary currently would like to shift the focus of the FSOC away from the collaboration and communication that it's currently trying to promote, there's not too much that could stop them legally. So it's another concern I have. So what I would like to see, ideally, is sort of, and this is something that actually the IMF has recommended in its latest, or in its, I think it was its 2015 FSAP for the United States. It said that the individual agencies should be charged with thinking about financial stability. If we're not going to have a financial stability regulator with resources, with staff, then the individual component members of the FSOC should be given that charge, that in addition to their mandates, they should also be worried about financial crises. And I should say, I haven't gone to the trouble of defining financial stability for you guys. That's something I've done a lot of in my work. I think there tends to be this sense that financial stability is static, that it's ossification, that it's avoiding risk-taking, that no institution should ever fail. And I think that that is an unfair and incorrect characterization of what financial stability regulation is. Financial stability regulation wants a vibrant, moving system where institutions can fail. It just wants those institutions to be able to fail without having a broader impact on the broader economy. So we're thinking about broader ramifications when we're thinking about financial stability regulation. It's not micromanaging each individual institution. And I would like to see different agencies charged with contributing to that effort more than they are in the current structure, which really at most gives them sort of an implicit direction to help the FSOC with its financial stability mandate. So I guess in sum, this is an area where I think the FSOC has a contribution to make, is making a positive contribution, could potentially be steered away from making that positive contribution because of distractions about its designation power. And I would like to see, hopefully, things swing the other way, so that instead the FSOC can be a more effective forum for collaboration, discussion of the types of risks that are pertinent to the different types of financial system, risks that could move from one sector to the other with the impact that the broader economy ends up tanking, we end up in recession, economic growth and credit become unavailable. These are the types of outcomes that I would like to see avoided, as everyone would. And I think that by bolstering the FSOC, we have a better chance of doing that. Thank you.
Excellent. All right, so I'll ask David,
Yeah.
you want to hear from there?
I'll also go from here. So it's a pleasure to be here. And, I think there's many subjects. Somebody who studies financial regulation is sort of, as I do, is sort of by default, interested in the way that, business works and the way that markets clear. And so there's a market-oriented component to any sort of student of financial regulation, which I think makes it a congenial subject for the kind of people who are in this room. And yet, financial regulation is also a real challenge for market-oriented critics because the financial institutions in this country are extremely heavily regulated in a way which basically makes them somewhat intertwined with the government. And indeed, there's an argument that some things that financial institutions do, the provision of money to individuals or access to credit to individuals and businesses, as Todd was sort of talking about, is, if anything, a public good. And my message that I'm going to talk to you about, I'm not sure it'll, we'll see if it totally works out, but I kind of want to do three things, and they all are related to the idea that everything is fine. Financial institutions are heavily regulated, and we should all be glad that they are. And I want to suggest that the alternatives, which I'll run through, to the kind of regulatory system we have are unappealing. And so we should celebrate the intrusive hand of the states, compression on the animal spirits of bankers in a way that I'm sure we all will at the end of this session. So I want to do that by sort of running through the base case for financial regulation as opposed to some of its alternatives. I want to talk about the way that financial enforcement against large banks happened in the wake of the financial crisis, which I find to be surprising. And then I want to talk a little bit about how, in particular, the post-Dodd-Frank reforms appear to have done a good job at making banks safer and sounder. And so I, like everyone on this panel apparently, and Elizabeth Warren and what's his name? Yeah, Henserling. Think that too big to fail is not over. But I'm a little, I think it's not doing very well. And I will say there are some people who think it is over. One of them is the former chair of the Federal Reserve, Janet Yellen, and the other is the current chair of the Federal Reserve, Jerome Powell, who both said that too big to fail has ended, and the reason is because of the fantastic regulatory structures we've put in place. Okay, so what do you need to what sort of position do you need to take if you want to argue that the financial regulatory framework we have is badly misguided? It's not impossible to make those kinds of arguments. He's not totally opposite, but one famous Stanford economist, John Taylor, who's regularly mentioned as a potential chair for the Federal Reserve, thinks that what central banks should do should be relatively easy. He's focused on monetary policy, and he just says, apply my rule, the Taylor rule, to monetary policy, and then call it a day. So the idea there is that the Fed wouldn't do much, and it wouldn't do much about banks, and its monetary and supervisory role would be relatively limited. It's worth noting that John Taylor is always mentioned as a candidate to be the next chair of the Federal Reserve, and often receives a lot of opposition for that candidacy from Wall Street itself, which appears to want to have somebody in the Fed who is more able to depart from the conventional monetary policy that Taylor advocates when necessary, and in particular to bolster the financial system. Okay, secondly, you could take a different approach to the regulatory state. You could argue, like Chuck Calamiris does in Columbia, that everything the government does is stupid. And that market discipline is a better approach, and it's a better approach in financial regulation in particular. And there are lots of ways to look at what the government does when it regulates banks and think, boy, that is pretty dumb. But everything is stupid. Chuck Calamiris thinks that we shouldn't have deposit insurance. In other words, that people who put their money in banks should be responsible for monitoring the safety and soundness of those banks. I guess the question is that the kind of world we want to live in, where there's no such thing as deposit insurance? You're on your own when it comes to figuring out whether your bank is safe and sound, and if you make a mistake, you should be more careful. It's worth noting that deposit insurance is an American invention which is being copied by the rest of the world almost wholesale. If you believe in looking at markets, it certainly looks like the market for law is a market that approves of deposit insurance. What about capital rules? So the most important rules that banks face are the amount of capital they have to hold in reserve to deal with a shock to the system or a downturn. So if you took a radically free market approach, you could argue there shouldn't be capital rules. We should just have the depositors, as I've talked about, the shareholders of banks make sure that their managers aren't doing something risky, and the creditors of banks make sure that their counterparties, the banks themselves, aren't engaged in risky conduct with somebody else. But there again, I guess I want to know, really, is that the kind of world we want to live in, where we trust hedge funds and private equity funds to monitor the safety and soundness of financial institutions in which we have put our money and on which we depend for credit? I don't know if that kind of a world really makes sense. And certainly, again, the market for law, the worldwide market for law, is a market that universally includes capital requirements for banks. So I'm not sure that free market approach is very appealing either. Okay, well, what else could we do if we didn't want to have the bank regulatory system we did? We could, get rid of fractional reserve banking, that is something that you sometimes hear some radical sort of gold bug-oriented people say is a tragedy about our financial system. One of the advantages of the banking system is not just that it directs capital to effective uses, but also that it creates wealth. It has that money multiplier effect, which depends to some degree on fractional reserve banking. And if you don't like that money multiplier effect, if you think that every bank ought to keep $1 in the vault for every dollar it lends out, then you have to say, I want a much less prosperous and effective financial system. And it's worth noting that prohibiting fractional reserve banking would be a pretty intrusive form of regulation itself. So that's why I think that what we're left with when it comes to financial regulation is a regulatory system. Banks have obvious externalities, they provide obvious good services, and they're obviously contagious and subject to bank runs and panics. We tend to regulate externalities when we see that. That's a good reason for regulation. Financial regulation is one of the most obvious, their financial institutions, our financial system, is one of the most obvious sources of benefits, but also risks with this contagion problem. And so it makes sense for financial regulators to say, let's have a financial system Let's make sure that banks are safe and sound. And so that's the regulatory system we have. Okay, so now I want to turn to what happened after Dodd-Frank and observe one thing that I think is curious, and then make the case that even the regulatory system we ended up with, while not perfect, but the perfect is the enemy of the good, seems to be making a difference and is going fine. Okay, so the thing that is surprising to me, and I don't really know what to make out of this, is that in enforcement after the financial crisis, no bankers went to jail, famously, or maybe one guy did because he took a plea, and that guy was a mid-level banker, and he made obviously a huge mistake because he's the only banker who went to jail in the wake of the financial crisis. And that is really, really surprising. Surprising in a way that suggests to me, and a way that maybe you agree with, that financial regulation has some unappealing features that have changed in the wake of the financial crisis. Because usually when there is a financial crisis, a bunch of people go to jail. And I'm often sympathetic with the defendants in those kinds of cases. So after the savings and loan crisis, over 1,000 savings and loan executives were prosecuted for various forms of financial and other kinds of fraud. After the dot-com crisis, we all know what happened to the Enron CEOs and the WorldCom CEOs, but the fact is corporate chieftains went to jail in the wake of the dot-com bubble explosion. And I just assumed that that was a feature of financial crises in general. That somebody pays a price at the end, and that somebody is usually, there's usually a few of them, and they often are quite high up in the firms they're at. So one of the things that happened in the wake of this financial crisis is that none of that happened. It was very logical to argue that, that in fact the CEOs of Wells Fargo, Bank of America, JP Morgan, and Goldman Sachs shouldn't go to jail for the excesses of the crises. It's not clear they were directly monitoring the rogue traders, to the extent there were rogue traders, who were making sort of insufficiently hedged bets on the housing market that went awry for banks and led them into trouble. And it's not clear whether any representation that was made in the sale of some complicated security or derivative transaction was something that was known at the highest levels of the bank, even when those derivatives were packaged in a way that the SEC concluded was misleading for investors. But it is definitely the case that we have this weird phenomenon now in financial regulation, which is that the regulators look, when I say regulators, I mean white-collar prosecutors, who you'd expect to be most likely to swing in after a financial crisis and throw some people in jail, look increasingly, I think even more now, like the people they're sort of on the other side of the table with than used to be the case in the past. So white-collar criminal defense used to be something that big law firms didn't really do. They would farm it out to small law firms, and as we've seen in the last 20 years, large law firms have increasingly added white-collar criminal defense practices that are profit-generating for their firms. And the people who staff those white-collar criminal defense practices are largely people who used to be experienced former prosecutors. And so one of the ways to guarantee a lucrative partnership is to do a successful prosecution in the Southern District of New York U.S. Attorney's Office of some executive securities fraud, right? Then you can take that and, like David Anders, go to Wachtell Lipton, which doesn't usually hire, lateral candidates. I think that on the one hand, one of the things that we see from the financial crisis, and this is a sort of sociological explanation, is that increasingly prosecutors can relate to the defense witnesses, and they see the world, or the defense lawyers at any rate, and increasingly to some degree to their clients, and they end up seeing the world in a somewhat similar way. So I think that's a weird thing, and that's one caution I have in the wake of the financial crisis. I'm no fan of white-collar prosecution for white-collar prosecution's sake, but I think it is certainly the case that something has changed about the supervision of banks. We're no longer talking about jail, and we used to when things went wrong in a financial crisis, and I'm not exactly sure what to make of it. There are reasons to think that it's a reasonable approach to assessing the very culpability of bankers who are caught up in an economic crisis where everything goes bad and not only their own decisions went bad. Okay, so the final thing I wanted to do was talk about how great the Dodd-Frank Wall Street Reform Act is as implemented. So here, obviously, I disagreed with Todd to some extent. There are ways in which you can worry about the regulatory red tape in Dodd-Frank. One of the ways is, for example, the Volcker Rule's applicability to community banks, which I think most people on both the right and the left think is an intensive and intrusive mechanism of supervision that doesn't really reduce systemic risk, which is all we care about, right? We're worried about the externalities and the contagion problem when it comes to regulating banks. And we don't really care what they're doing. If they're not contagious, then market discipline's a fine way to treat them. It's fair to say that as implemented, there are reasons to think that our financial sector is doing well. There hasn't been a collapse in the financial institutions since the passage of the act. Banking has become more boring. It's less profitable for bankers. The Volcker Rule is being enforced, and there's no longer proprietary trading desks at big banks that caused problems during the financial crisis. Derivatives are increasingly on exchanges, and they're on exchanges rather than being passed around through bespoke one-off transactions between banks, which meant that it was impossible to know what your counterparty's risk exposure was. They're on exchanges because Dodd-Frank required them to be on exchanges. This was a solution, market-oriented solution that the market couldn't come up with. Regulators came up with it, and they've made our derivative markets safer and more transparent. There are still more American banks, way more American banks than exist in any country. And when it comes to big banks, everyone worries about, too big to fail, but we have 18 big banks. There are 4 particularly large ones, but it's nothing like the kind of concentration that exists in almost any other country. We also have 5,000 community banks, if you look at the largest banks in the country from 20 years ago, you'll see that they're different from the largest banks in the country today in many respects. Different names, different firms, and different executives, to be sure. Nobody believes that too big to be fail is over. But look, bank shareholders got killed in the financial crisis. They haven't made their money back ever since. Banker pay is lower. Executive turnover at these institutions is higher. And banker pay is less related to short-term risk-taking than it was before the financial crisis. That also is attributable, I think, to Dodd-Frank. And also, finally, although people worry and are skeptical about how safe these institutions are, the fact is they've passed stress tests administered by the Federal Reserve and the Treasury Department. Those stress tests were rigorous, and some banks were failing those stress tests, and now they're not. They have way more capital on hand and capital that meets the terms of the Basel III capital adequacy rules, and it's much more capital than they were required to hold and did hold before the financial crisis. So to make an argument that things have gone pear-shaped in the wake of the financial crisis, you really have to believe that this has somehow been a huge brake on economic productivity. The fact that banks are clearly safer and sounder and less profitable and less risky is hurting the economy in some ways. And it is true, we can't know the answer to this question. We've had a very slow growing economy ever since the financial crisis, though it hasn't stopped growing since the financial crisis. But it's really hard to make the claim that our prosperity is being destroyed by new financial regulations, whereas it's really easy to make the claim that banks were underregulated before the financial crisis and should be more regulated than they were then. So with that, I've gone on for 16 minutes and 50 seconds, so maybe that's enough. I could also sing the praises of the Financial Stability Oversight Council, but I won't do that because I think Hilary has, and I guess I'll look forward to questions or interactions and stuff like that.
Great. All right. Well, thank you to all our panelists. As promised, we have a good range of views and perspectives, obviously, that we've heard from. I thought maybe I'd like to sort of encourage a little bit of sort of conversation between the panel, and then we'll open it up for discussion. I'd welcome, obviously, any sort of reactions you have to one another, but maybe to get that discussion started, a couple of things that I sort of scribbled down as I was listening to each of you. So one question I wonder is, for each of you, how do we think through, how do we navigate change, right? So in other words, if we agree that the financial landscape looks different post-crisis than pre-crisis, and not just because of the regulatory changes, but because, again, there are secular changes in the nature of globalization and other things about the financial order or financial structure. You can imagine various responses to that. One is a pure market response that says we leave it to the market and the market will work itself out. The other is we are fairly aggressive about it. I think in some sense FSOC could be thought of as yet another response, right? We try to coordinate and sort of talk about it, not exactly, but that there's some conversation around it. So I wonder whether you have reactions to that, sort of each of you, of, again, if we agree that the financial crisis revealed something about changes, or either revealed or created changes in the way, what our financial order, what our financial structure looks like, what is the appropriate way to respond to that or not respond to, as the case may be? I don't know, whoever wants to start can.
Yeah, well, I want to pick up on something David said that's related to that. As David mentioned in passing, the entanglement between banks and the government now. And that entanglement now is greater than it ever has been, right? That basically, the banks made all these ridiculous, stupid decisions. They managed to get us to bail them out, but they paid a big price for it, which is that under the Obama administration, they basically they got their pound of flesh out of it, right? Unfortunately, the way they got their pound of flesh is the way in which sort of third world regulators get their pound of flesh out of the banking system, which is basically more of a crony-style system where they basically put the screws to the banks in the back room and basically got them to do things that they want to do. And a good example is Operation Choke Point, if you're familiar with that, which is where the banking regulators basically strong-armed the banks into not providing banking services for certain industries that the Obama administration didn't like payday lenders, who basically lost access to bank accounts. Gun shops, some gun shops found that they lost access to bank accounts. Porn stars, basically, and the FDIC had an internal memo that said, make sure every time you talk about Operation Choke Point, you mention porn stars, because it'll make the whole thing seem justifiable, the stuff we're doing, right? That's the kind of backroom sort of cronyism, sort of informal type stuff that we get when we get when we get government regulators entangled with the banking system. Another example is Ally Financial, if you're familiar with the way they've handled auto dealers at the Cfpb, which Dodd-Frank prohibits the Cfpb to regulate auto dealers. But they really wanted to get at them, so they regulated the banks to provide money to auto dealers. And so in the Ally Financial case, for example, they wanted to make an example out of them. They wanted to make them settle. Why did they pick Ally Financial? Not because they had any evidence they had done anything, but because at the time the government still owned 2/3 of Ally Financial, which had been GMAC. Ally Financial had a pending application to become a Federal Reserve, to get certain privileges from the Federal Reserve to be able to sell insurance and used car financing and that sort of thing. And the CFPB had the ability to hold up the approval. And so they basically said, if you want this completely unrelated thing, you dance to our tune, and they basically shook down Ally Financial for a whole bunch of money in order to do this. Now, of course, the irony of that was they got, I think, $90 million, but they didn't have any real victims, so they basically started sending out checks on the honor system, and people would just self-identify as to whether or not they got a check or not, right? But that is sort of the administrative state on steroids, right? That's the kind of story that we always suspect is in the background of the administrative state. But that's the kind of things we've seen now in the financial systems, Operation Choke Point and Ally Financial and that sort of thing. So one of the goals, I think, is to pull back from that entanglement and all the political agenda that's associated with what that is. So one thing I think is particularly innovative, the main legislation that's proposed in Congress to deal with Dodd-Frank is called the Choice Act. And it was introduced in the last Congress, and now it was reintroduced this past time by Jeb Hensarling. And one of the innovative features of that is that I think is a model for an interesting way of thinking about financial regulation and regulation generally is they have a provision they call the Dodd-Frank Off-Ramp, which is they could basically say, we're not going to reduce necessarily regulation across the board, but we're going to give institutions a choice. there are different ways to reach the same regulatory objectives. One would be the way we do it now with very heavy-handed, sort of intrusive financial regulation. But so the other way to accomplish the same goal would be to just figure out how much capital you need to hold in order to be a safe institution. And I think they drew the line at 10%, right? So they said if you have 10% capital, you can get out of a lot of the regulatory stuff that otherwise is imposed on you, right? And that, of course, is very beneficial to small banks because small banks tend to hold more capital to begin with. But as I said, a lot of those regulatory costs fall harder on small banks, right? I think that's an ingenious way of thinking about regulation, which would be, you got a goal you want to accomplish. Let's think if there are different ways to accomplish that same goal and allow institutions to opt into the system that will be less expensive but equally efficacious.
Todd, could I push you on? So again, up of how we respond, and it's a change question I'm asking. So the Choice Act is a good example in some sense of raising the question of your unintended consequences point, because it's obviously hard to know. Complex structures, given the integration that David mentioned and you echoed. So again, in some sense, when you emphasize unintended consequences, you might imagine that leads to a paralysis, which may be the result we want, right? A paralysis result that says even the Choice Act isn't good because, again, it's very hard for us to evaluate what the unintended consequence of the Choice Act will be. So that's why I want to get at sort of how do we react to this complex system that we have created in some sense without throwing up our hands and saying either there's nothing we can do about it, or alternatively, we have to accept the fact that there will be unintended consequences of some of our choices.
Yeah, I'll just add one last thought to that and then turn it over, right? There's different ways you can think about regulation. We've always tended to think of financial services as basically how do we preserve the stability of banks, right? An ex-ante approach sort of prevent to do it. And I think Hilary alluded to this, right? It's not necessarily the case that making every bank stable and safe is consistent with making the whole system stable and safe, right? So I agree with Peter Wallace in that one of the big reasons we had a financial crisis was because regulation basically imposed a relatively homogeneous and consistent requirements on balance sheets of all banks. So that when one asset class went bad, which is mortgages, that's what created the contagion effect. I don't think we would see so much similarity in bank balance sheets if we didn't be thinking in terms of sort of the Platonic form of the perfect bank balance sheet, right? So I think one thing we should think about is to what extent does variety at the systemic level provide more stability than trying to micromanage every individual bank, right? Individual bank instability may be more consistent with overall banking system stability, I think is what Hilary said. The second thing I think we should be thinking about is, well, we're in a world of uncertainty, right? There are going to be things we don't anticipate. And so to what extent should we be thinking about of how do we make the system resilient to shocks after the fact, as opposed to thinking we can prevent all the shocks before the fact, right? And that's not necessarily the same regulatory regime, right? And it relates again to this idea that maybe more micro-level instability is consistent with more macro-level stability. And in Nicholas Taleb, if you're familiar with Anti-Fragile, Nicholas Taleb's book on this, that I think is really sort of thinking in a world of more uncertainty and unintended consequences. Maybe we should think about it as being resilient on the back end rather than preventing stability on the front end.
Yes, I mean, there's a big debate about ex ante versus ex post regulation, and I guess I'm with David on the don't let the perfect be the enemy of the good, and I would like to see both addressed. I think you raised an important point, Bobby, that there have been secular changes to the financial industry since Dodd-Frank happened. I mean, one of the, I guess, an Achilles heel of any type of regulation, but financial regulation in particular, is that it tends to be a response to the last crisis because, it's very hard to get people excited about regulation and to get public support for regulation unless a crisis has just occurred. So that is sort of a natural tendency. And what we're seeing now is that, and I think you alluded to this with some of the new type of entrants in the consumer market, is we're seeing the rise of fintech, right? And fintech was not anticipated by Dodd-Frank at all because it didn't exist really. I mean, fintech in many respects was a response to the disgust that people felt with the traditional financial system. Ironically, now fintech has really been fully absorbed into the traditional financial system, but it evolved initially as a sort of a rejection of the traditional financial system. So we have all these kind of new technologies, and there's nothing in Dodd-Frank to deal with them per se. You get some very interesting dynamics, like perhaps the rise of these fintech firms. Maybe we want to encourage this outside of the regulated industry because maybe they could compete away some of the too big to fail bank market share. But there are regulatory barriers to entry that fall particularly on smaller institutions and that they don't have the scale to meet that prevent them from becoming that competitive force. So we've got sort of a different set of issues to consider now. I think, again, Dodd-Frank is by no means a perfect piece of legislation. I think it addressed some really important things with regards to the largest financial institutions. I do agree that it was heavy-handed with respect to smaller and community banks, and I would like to see some kind of rollback there. I don't agree that the 10% capital surcharge or capital charge that is envisaged by the Choice Act is the silver bullet that will fix everything. I think that is far too low to be sort of the only regulation that applies to an institution, particularly a larger institution. But I would be very open to seeing sort of more regulatory relief for the smaller and the community banks. And I think, maybe we talk about whether we need to have regulatory relief for the fintech firms to enable them to really compete with and stay outside of the world of the largest financial institutions. But as I said, Dodd-Frank doesn't address any of this, but nor could it, right? And so again, I don't let the perfect be the enemy of the good. I think Dodd-Frank does a lot of really good things with regards to the very largest financial institutions, and really that was the main target. The unintended consequences are that some of those regulations sort of fall quite bluntly on smaller banks and community banks, and that's where I think reform is particularly needed.
Yep.
So I don't know if this totally, this sort of riffs on the question rather than answers it, but one of the things that's weird about banking is how difficult it is to avoid the intertwining of banking and governance. And the reason I think this is the case is I sort of take a historical approach to thinking about why we have a Bank of the United States or a Bank of England. And the reason the Bank of England was set up, and the Bank of the United States too, was to make sure that there was a market for government debt, right? So it's a form of state financing that really creates the large and sophisticated financial markets that we have today. And the Federal Reserve now depends on primary dealers to implement its monetary policy. It either buys treasury bonds from them or sells them treasury bonds. And what are primary dealers? Well, they're the 29 or 30 largest banks, not all American, who have said that if you want to do something on monetary policy, do it with through transactions with us. And that's what the Fed does. So separating the government policymaking and the financial system is incredibly difficult, and it has been ever since sophisticated financial institutions came into existence. So what can we do about it? Well, one thing we can do, and one of the things I think is okay about the Financial Choice Act, I like the Volcker Rule regulatory relief for small banks, and I think off-ramps might be okay. I sometimes wonder whether off-ramps are going to be a solution to the interesting and troubling problems of what to do about banks, because they'd only apply to small institutions, and the institutions we really worry about, the ones that we would never let off Dodd-Frank financial capital requirements or whatever, are the 18 big ones. And these 18 big institutions comprise the vast share of lending in the United States, or bank lending in the United States, I should say, and the vast amount of market capitalization and assets held and all that kind of thing. And I don't see how we can get them on an off-ramp from the regulatory requirements of the statute. What else could we do? Well, one thing we can ask is there access to credit for businesses and individuals that's being offered by the financial system? And one of the reasons I'm okay with the financial system we have now is I think we do get this access to credit. And I think one of the things that isn't bad about the American financial system is access to credit increasingly, as Hilary was just saying, is not just coming from banks. There's a non-bank sector that's providing credit, and I don't think that's particularly bad. The question becomes when the non-bank provision of credit, firms are getting financed by private equity rather than going to their local merchant bank, or not merchant bank, their local commercial bank or whatever. That's not necessarily a bad thing, nor is fintech or social finance for the provision of credit to individuals. And the question becomes, when are these forms of credit going to become sort of risky in the way that bank lending can be risky? And I think we're a ways away from that so far.
Great. Hilary, I wondered if you have any thoughts on and others can chime in as well, particularly about FSOC. There obviously some analogy to the international structure, right? So we think about international financial regulation. In some sense, it is this massive exercise in trying to coordinate a multiplicity of regulators. So is there anything to learn in either direction from that? And then other thoughts on sort of international dimensions of the post-crisis world from Hilary or from others as well?
Well, I'm probably stepping on David's toes here because this is his area. But I think there are a lot of different models of international financial regulation. I mean, you have sort of the IOSCO or the IAIS, which are the securities and the insurance international bodies, respectively. And those are ginormous. I mean, they have over 100 members. They try to do things by consensus. They're not particularly effective on setting standards. They do issue some reports. They actually are pretty good on extradition treaties and enforcement memoranda of understanding. But that's not really what we're getting at with the FSOC. I guess probably the closest analogy, if we were going to talk about the FSOC, would be the Basel Committee, which is a smaller group. It's only the top 20 economies, I think, that are represented. Is that right? Is it G20? That are represented on it. That they tend to come out with more sort of formulaic standards. Not formulaic, detailed standards. So that would probably be a closer analogy. But in fact, the Basel Committee in many ways has a lot more power than the FSOC and a lot more resources. So, and it also has, it's comprised of members that really sort of tend to be committed to a common goal. So in that respect, it's sort of more disciplined and more fortunate in trying to achieve its outcomes than the FSOC. So I guess the argument that I've made that I want to see individual regulatory agencies in the United States be charged with a financial stability mandate would probably sort of get us closer to potentially the Basel situation. But the FSOC has no power to sort of disseminate rules that are standards binding upon individual institutions. So, I mean, I guess you could draw sort of broader lessons about coordination and communication and how to improve things like that. I mean, but that would be the same as any other kind of organizational literature. So I'm not sure there's too much there. But do you disagree?
Other thoughts on whether FSOC or more generally in terms of the international dimensions of what we've learned or not learned?
So, I mean, one of the things that I think is fascinating about financial regulation is that the international dimension is so important. So capital rules are being set by this Basel Committee on Banking Supervision, which American financial regulators have joined, but they don't control or anything like that. There's no treaty that backs this up. This is the oddest form of international policy making that I've ever seen. There's no World Finance Organization. There's no world arrangement. Instead, what there is financial regulators getting together on a regular basis and coming up with common approaches to how they're going to regulate their financial markets at home. And it's crazy that this is generally complied with. It really matters for the balance sheets of banks in particular, but insurance companies are also really worried about this, and is totally informal as a mechanism of law. So why do we tolerate it, or what's good about it? Well, I mean, the fact is that financial markets have globalized, and so it's difficult for American regulators to think that they could adequately monitor American banks without knowing what those banks are doing overseas, and vice versa. So in some ways, it's a necessary solution to the globalization of finance. It's odd the form that it's taken. The thing I'm most going to be interested in seeing going on internationally is what happens to American insurance regulation, because American insurance regulation was done by the states and wasn't coordinated with their foreign counterparts. In the wake of the financial crisis, there's been an effort to sort of federalize it through FSOC. And I thought that was an interesting and maybe even effective form of supervision, but it's certainly something that insurance firms are totally worried about here, that the rules they have to comply with are going to be set through an international process rather than a domestic one, and we'll see if that happens.
Any thoughts on the international piece, Todd? Let me throw out one other question for sort of everyone in the group, and then we'll open it up for your questions. So going back to where we started, Todd pointed out that sort of the lack of anyone taking the view that too big to fail has been solved or has been addressed. David suggested, okay, there may be a few, and obviously pointed out we may have moved closer to that. from my vantage in my sort of work on coordination games, obviously this is fundamentally an exercise in expectations and coordination. Can we coordinate around we don't expect a bailout, and if we can, then we get there, and if we can't, we can't. So I wonder whether, again, so this is a little bit starting with Todd, but then other reactions too, is there a way to effectively coordinate expectations around, given history, obviously, because that's the hangover in any coordination setting is you shape expectations based on historical precedent. Is there some way to in fact, put the whatever it is, the stake in the heart of too big to fail, or is it really just we have to resign ourselves to it, in which case then your response may be right, that your earlier point about we're not going to prevent it, but what do we do on the back end in some sense? But thoughts about that?
Yeah, I think it's a hard question, and it's basically this question of credible commitment, right? And they asked Tim Geithner whether Dodd-Frank got too big to fail in a recent interview, and he just laughed and he said, "Of course not." But it does raise some interesting questions, right? My intuition is what we have right now is probably the worst of all worlds, which is a law on the books that nobody thinks will actually be applied in practice. That creates a huge amount of instability. It starts to look like the alternatives are something like accepting too big to fail or breaking up big banks to a stage where they aren't too big to fail. Ideally, there'd be some third way in there that would be more of a credible commitment. But I don't think they've really kind of tackled that or thought about the reality that in practice, with a regime on the books isn't expected by people to be the regime that's actually going to be triggered in practice. So I've not come up with a solution to it. So.
I mean, I agree. I think the only way to really get rid of too big to fail would be to break up the big banks. But that, to go back to the international dimension, that would be sort of a very interesting conundrum. I mean, as David mentioned, we already have so many more banks in the United States than any other country. It'd be interesting to see whether, if we actually took that step and had lots of smaller banks, how that would work on the international footing where the other countries would maintain their sort of four pillars typically of very big institutions. And I should say, in those countries like Canada, like the UK, like Australia, where there are just the sort of the four big banks or however many, like there's more of an acceptance, I think, of the government involvement in the financial system. Those big banks tend to have quasi-governmental status. Mm-hmm. So maybe we are in the worst of both worlds. We have all these banks, but we haven't sort of accepted that they are in many respects government instrumentalities. So maybe you bite the bullet and say these basically are government instrumentalities in many respects. Or do you break them up and leave us in a place where we may be globally disadvantaged at a competitive perspective because we have all these smaller institutions and then you have other countries with bigger ones? I don't know.
I don't have much to add, except, the problem is really hard if you create a lender of last resort, which is conventionally the thing that the central bank can be, as long as it only bails out illiquid institutions rather than insolvent ones. That's the right way, canonically, to have a stable banking system without encouraging banks to take far too many risks than they should. And it's really difficult to get to the point where there's a lender of last resort who doesn't ever have to lend, if that makes any sense. And so, getting there may just not be possible. And so then the question is, are we in the worst of all worlds, or are we in a muddle-through world that's going to be required because of the way the financial system works?
All right, well, let me open it up for questions from the floor. We have a mic up front. The folks can step up and would welcome your questions, whether for the panel generally or for individual panelists.
That was a gloomy consensus.
Yeah, exactly. Please be uplifting. We would ask the question to be something to.
Hi, David Rees from Brooklyn Law School. Todd, a question for you. So the core principles for regulating the financial markets executive order led to the Treasury reports on creating a financial system to create economic opportunities. The regulation of the Cfpb is discussed in all of those reports, and I'm curious as to your thoughts about loan level regulation of mortgages in particular, and whether the Trump approach, which seems to want to expand the credit box for lending, has implications for systemic risk in the financial system. In other words, does consumer protection level loan regulation reduce systemic risk, or do you think that it is not relevant to the reduction of systemic risk?
Yeah, good question. And here's what bothers me about CFPB is that they've got a mindset that they see every single question as a consumer protection question, and that consumers are just victims of the system, right? So that leads them to assume, for example, that the issue with payday loans is ability to repay. There's no evidence that that's the case, right? It may be true. There's no evidence that it's not the case, but a lot of payday loan customers understand that taking out a payday loan is a free default, right? They're not going to get sued if they don't take out their payday loan. It doesn't hurt their credit score. So you can't just assume that people don't pay their payday loans because of an ability to repay. And it's the same with mortgages. They've gone into the whole thing and just assumed that what caused the financial crisis was fraud against consumers and an ability to repay their mortgages, when in fact, the evidence strongly shows that at least a contributing factor, if not a larger factor, was the deterioration of equity requirements, right? The loans that lenders made were stupid loans, right? Negative amortization loans, for example, with nothing down, especially in a state that had a non-recourse law where you could only take the house and couldn't sue for the deficiency. Those are really stupid loans, but they're not stupid loans because people didn't understand them. They're stupid loans because people did understand, right? That when your house is underwater, the best investment you're gonna ever make in your life for most people is walking away from a house that's $80,000 underwater. And if you're in a state like California that has a non-recourse law where it's basically a get out of jail free card, that's what people did. Right? So clearly there is room for sensible regulation, but you've got to actually identify the regulatory issue, and you've also got to recognize that consumers over the long run do act rationally with respect to these things. So if you set up a set of rules that's premised on the idea that it was an ability to repay issue, as I showed on the data, nobody thinks that actually affected this, right? You've got to be thinking about things like, well, what are the underlying incentives? What are the impact of state non-recourse laws? So they've got that. They actually create more protection for that in Dodd-Frank, which would exacerbate a foreclosure crisis again in the future if housing prices fall. So absolutely, yes, is that there's room for sensible regulation, but it's got to be really seriously empirically grounded regulation that understands what's going on and doesn't create moral hazard problems for consumers and banks and everybody else as well. And so I think a good case can be made that we want to require 20% down payment, for example. I don't know if that's the right number, but something like that, right? Require equity retention. In Europe, housing prices went up, housing prices went down. They didn't have a foreclosure crisis that looked at all like ours, and one of the reasons was people weren't stripping their equity when their house went up in value. They retained their equity, and so they had a housing bubble and crash, but most countries had a foreclosure rate that was a fraction of ours. They have much stricter foreclosure laws in Europe, and so people didn't exercise the option to default like they did here. So I think there's a lot of room for regulation, sensible regulation that could stabilize the system as well as protect consumers.
So let me just push. So if the Trump administration, the Treasury reports is looking to loosen that loan level regulation, I mean, maybe the answer is we haven't studied empirically enough. But is your take that the current state of affairs is too restrictive and that there is a room to loosen, or you're agnostic on that question?
No, but I think we need a different way of doing it. I wouldn't loosen it. I would consider changing it. I would look more seriously at down payment requirements, which aren't part of QM. I would think about what is really the ability to repay. So, for example, a good example is they just blatantly misrepresent some evidence in the qualified mortgage rule. When they talk about so-called exotic mortgages, like negative amortizing mortgages, there's only one study that's done on that, and what that study concluded was negative amortizing mortgages were made disproportionately to very high income, high wealth consumers with high credit scores. And the reason why they cratered and resulted in foreclosure so often is that when those homes fell in value, those were very sophisticated consumers who walked away from their homes at very high levels, right? We may want to prohibit negative amortizing mortgages, right? They do prohibit negative amortizing mortgages. I wouldn't necessarily relax that, but I would understand that what was actually going on. And same thing with down payment requirements. Is I could see a case to be made for stronger down payment requirements. greater, equity retention by consumers in their houses. I wouldn't say that necessarily is relaxing mortgages or regulation or not. I would say it's transferring regulation in a way that I think makes more sense and is actually more responsive to consumer protection and systemic, and safety and soundness questions. So perhaps we place less focus on ability to repay and more focus on, are you putting enough equity in your house, for example?
Thank you.
Steve Ware, University of Kansas. Question for Todd is whether you think Hilary and David are right that failure of a big bank has been reduced, the chance of it has been reduced by Volcker Rule, stress test, and FSOC. And then question for David is deposit insurance. You didn't have a lot of time, but I got the impression you were saying that the government insurance we have now, the alternative you envision is no insurance at all. Why not private deposit insurance? Most people, their bank account is worth less than their house, and we have for homeowners insurance, State Farm and Geico and all. Why not have that for deposit insurance?
Yeah, I'd have to think more about that. I mean, I think it's reasonable to think that that there has been risk pushed out of the banking system to other areas, which at the margin would make it less likely that big traditional commercial banks would be less likely to fail. I'm not sure that increases the overall stability of the system rather than just displacing it to other corners of the system, though. But which other corners? Yeah, so for example, like I said, the rise of non-bank lenders, that basically by pushing banks out of the mortgage lending market, we've pushed it off into non-bank lenders, right? And, I mean, that may be fine, right? They're basically being funded by investment and venture capital and not by deposits and the banking system and that sort of thing. So the risk is still there, obviously, and maybe overall that makes the system, maybe it's better that it's there than it is in the banks. So I'd have to think more about the overall effect on the system. But I'm willing to believe that at the margin, the way the regulations work is reduced risk. I haven't looked at enough to know what the cost and benefits are of that and whether the benefits exceed the overall cost of them.
So I want to say two equally and oppositely inconsistent things about deposit insurance, which is first, you have to have the government backing deposit insurance, and then second, we already have private deposit insurance. Okay, so what does that mean? In theory, deposit insurance in the United States, and in practice, I think this is the case in most places, is paid for by a levy on the insured institutions. And so in some ways, it's the government facilitating the creation of a government-run corporation, the FDIC, which is an insurance company, and like other insurance companies, regulates policyholders to make sure that the policyholders aren't engaged in risky activity. That is, I'm not going to pretend that the FDIC isn't a federal agency, but in some ways there is a private component, and it's a private component which isn't being left to the government, which is being facilitated by the government. Okay, so what's the alternative? I guess, we see insurance companies, right? They purchase reinsurance, and that's how they lay off some of the risk that they're engaged in when they make investments. Could we have a private reinsurance program that would work in a private reinsurance market that would work to provide deposit insurance to American investors? There is a question of scale. So insurance companies do make big bets, of course, but could a private market get up to the size where it could actually guarantee that deposits held in banks are in fact insured? And then secondly, there's this question, and this is a government backing is necessary. I don't know if this is true. I refer you all to Gary Gordon's work on safe assets. But he has this view that, one thing that government can do, and sometimes they do this sort of hypocritically, is they can give investors and everybody something that investors and everybody craves, which is you put your money away in some place and you forget about it because you know it's safe. And that kind of safety and security is, supposed to be market enhancing because it gives people the confidence to engage in market. So if you believe that, then you may want a private deposit insurance system, but you may want to know that assets in banks are in fact safe assets, and so have some sort of government guarantee behind them as well.
And I'll just interject on this. I'm by no means an expert on the historical background here, but I'm pretty sure that prior to the introduction of federal deposit insurance, there were in fact a lot of privately operated insurance schemes for deposits, and they weren't actually effective in providing the level of confidence that the government can provide. So it has been tried.
Other questions from the floor? Please.
When I hear financial crisis, I just think of the movie The Big Short. And so I was wondering if the panel could address whether that was a fairly accurate representation of practices that were going on, and to what extent Dodd-Frank addressed that. And then the other thing I think of is Glass-Steagall. I hear the repeal of Glass-Steagall was one of the causes of the crisis, but I've never heard anybody seriously propose reimposing it. And have I missed something? Can the panel address that?
I'll address The Big Short because I think it's an interesting thing, which is the book and the movie are not exactly the same, even though they have the same plot. And here's what I mean by this is there is still one huge, to my view, unresolved overarching issue about the financial crisis, which was it basically caused by venality or incredible stupidity? Right? Did they know what they were doing and basically, with the securitization and everything, and were basically playing a game of musical chairs or sort of a Ponzi scheme where they're going to just keep passing the paper along to people? Or were they really just that stupid and that they got tangled up in their models and, their complex financial engineering, and they believed that they had offset the risk? So there was this one memo that came out after the Lehman collapse where they were speaking internally, and they were like running models on these things, and one of them said, well, this is totally unrealistic, but we've built in, a 10% probability of a complete doomsday scenario, which has never happened before, which is that housing prices will fall 5% in America 2 years in a row, right? And they said that you're going to laugh at us because it's so extreme, right? But they seem to genuinely believe it, right? Which is that it was unprecedented. So I think it's an interesting question, right? Which is when you read the book of The Big Short, the way I read it was a bunch of it was just stupidity that people believed that they had, that they knew what they were doing, that they were running these complex models and using these complex things and using all this data. If you watch the movie, it looks more like it's fraud, right? And that they not that they were incompetent, but that they were crooked. And I think that question, to some extent, we'll never know the answer to that question, but it makes a big difference in terms of thinking about regulatory responses, whether you think it's a problem of incentives and venality or just human incompetence. So, and I'll let them talk about about Glass-Steagall. So.
Well, I'll jump in on that. I'm not so sure that incompetence and venality are mutually exclusive. Sort of my sense of things was that people did make some silly assumptions, but part of the reason why they made stupid assumptions was because they didn't care about the consequences. One of the sort of famous acronyms that you hear trotted about pre-crisis with people saying IBG, YBG, I'll be gone, you'll be gone by the time any of this actually hits the fan. So I'm not sure that they're extricable necessarily. But with regards to Glass-Steagall, which was the legislation passed after the Great Depression to separate the banking and the securities industries, I think there have been at least rhetorical calls to reintroduce Glass-Steagall in the wake of the financial crisis. Practically how that would work, I don't think anyone has there have been lots of different proposals as to what a reintroduction of Glass-Steagall would actually look like. I mean, the banking industry is just so different now from how it was in the 30s that I don't think we could put the genie back in the bottle and do the separation that they did in the 30s. Particularly again because, as David's mentioned, we're dealing with a global financial system now, and no other country ever had that separation of banking and securities. And again, it would be a sort of a big deal in terms of international competitiveness, I think, to really sort of separate them out. That said, there are sort of ways of dealing with the concerns that Glass-Steagall was designed to create that are sort of less severe than literally ripping apart investment banking and commercial banking. So the Volcker rule is sort of sometimes being talked about as sort of Glass-Steagall light. You're pushing out the proprietary trading and those kind of activities from deposit-taking banks. So there have been moves along that continuum to get sort of some of the riskier activities out of deposit-funded banks, but I don't think there's going to be any genuine effort to go right back to the law that we had in the 30s. Do you disagree?
No, I think that's right, and I think maybe one reason why, in addition to the fact that other countries don't do it this way, is that it's not totally clear that the risks that securities firms take are so destabilizing. I mean, maybe I'm just wrong about this, but securities underwriting and investment banking got so many banks into trouble in the 30s, and it's not totally clear that stuff is as risky now as it was back then. It's certainly heavily regulated by the SEC, and so in that sense, activity restrictions are the earliest and easiest to understand form of bank regulation. Like you can't sell stuff like Walmart, or if you're Walmart, you can't open a bank. Or you have to sell stuff in one state or in one county. You can only, those kinds of activity restrictions are the oldest form of banking restriction. And Glass-Steagall is, I think, an activity restriction. If you're a bank, you can't do securities work. So it's easy to understand, but like I said, it's not clear to me that it solves a really important problem of risk.
One of the things that's funny is how these things kind of go, right? Which is after the savings and loan crisis, the conclusion was, well, the problem was all these savings and loans were holding all these mortgages on their books. Yes. So the solution is we've got to get them to securitize it and get them off their books, all right? And so then after this time they said, well, no, the problem is they were securitizing everything and getting them off their books, and they didn't care whether it was or not. And Dodd-Frank basically said, well, we're going to use baby bear's bed. And what is it? We're going to retain, they have to retain 10% of something, right? Because we already said you can't hold it and you can't sell it, but there's a magic number there in the middle that will create the perfection.
Yeah, I wanted to comment on The Good Short. And I only saw the movie and did not read the book, but I think, in effect, the stupidity argument wins over the venality arguments in terms of the ratios, to use Hilary's number. What one has to do is you sort of, first of all, on the conceptual side, the theory of course, setting this thing out is you get diversification by way of geography, right?
Mm-hmm. Right.
And what happens is when the guys were thinking about this, they didn't realize that the common mode risk was regulation at the national level, which you cannot diversify by simply taking things here, there, and the other place. So their initial situation was that they've handled this kind of serious problem of concentrated failure, when in fact what they did is they exposed themselves to a different risk, which was in fact greater of magnitude, because the level of regulatory stupidity probably exceeds that of natural disaster if you're worrying about something on a global scale. The second thing is, you remember what the bet was in The Big Short. What happened is, these guys had concluded that the market would go completely bust, right? And so what they said is, we think the A securities are every bit as much as risk as the D securities. What they did is they took all their money, right, and they bet against the A securities, and they got incredibly favorable terms, 10 times what they would have gotten at the other end of the market. And so what happened is they saw the connectivity, which the people at Goldman Sachs and everybody else did not see, which allowed them essentially to take the system and to drive it into bits. And that's exactly what you would expect, because whenever you have a flawed strategy, it only takes one guy, right, to understand what's going on, to bet the house on the other side. And if he sees it correctly, he's going to win the whole thing. And then your last comment, of course, is exactly right about Glass-Steagall, is you're always fighting the last war. I mean, there's not so much a question, it's an observation. So there's real risk in holding stuff. There's real risk in selling stuff. We all believe that they ought to do something in the middle. We don't know what that something turns out to be. And one of the reasons why the debate over Glass-Steagall is so inconclusive is, well, you have a bigger firm and it does multiple things. It gets internal diversification. Right. Oh, the great thing that's terrible about that is you lose expertise and specialization. You're now just an AT&T conglomerate, and we don't know which of these two forces are more powerful. So in general, I think the recommendation is, The only thing that seems to work generally is to say that you need to have more robust margin requirements on people, because that's the only thing that essentially is going to be relatively resistant to all of these regulatory stuff. And so that would be my set of observations. My question is, why am I wrong?
Well, first, after I answered Steve, I want to incorporate by reference the comments you just made. I've been thinking about my answer to Steve's question about where the risk goes and that sort of thing. Your point about internal diversification is an important one that I want to caveat my earlier off-the-cuff answer with and say I don't know on that. But with respect to what you're saying, I mean, obviously, it makes sense to me, and I think one of the interesting things, and I haven't followed the prosecutions like David had, but the idea that bankers didn't go to jail. My reading, just following this in the Wall Street Journal, is basically because what juries and people have said is this was really stupid but not criminal, right? I mean, is essentially, what is kind of how I read it, and that's why they haven't been able. They found civil liability but not criminal culpability.
There's only one group of people who should have gone to jail. And those are the guys who ran the government side of the Fannie Freddie bailouts. Right? Because that's just outright theft.
Right. Well, some of the things are pretty astonishing. If you've read John Allison or Richard Kovacevic's discussion of being strong-armed into taking bailout funds, is another sort of extraordinary story. And I'm not saying anybody should have gotten to jail for it, but
no. To give you one illustration of that, one of my clients was TFC Bank. And they were told that they had to take $360 million in bailout money, even though they were prudently run. And the explanation given was that they didn't want the public to see differentiation between relative bank qualities, which is a form of government fraud, essentially. So they got the money against their will, and then they had to go through about a year or two of administrative procedures before they were allowed to pay it back. Right. And the
reactions from David and Hilary?
Yeah, I mean, I think that's an appropriate response to a crisis. Which bank's risky? Well, we're bailing everybody out. So we're not just saying, watch out, it's Goldman Sachs that's going to go, Citigroup. So I don't really have a problem with, one of the ways I justify to myself how heavily regulated these banks are is that you sort of have to take the bitter with the sweet. So the sweet thing is you get a bank charter and access to, insured deposits.
And preemption of a lot of state regulation.
Yeah, so I mean that's awesome, right? That's a great thing to run a business. And if the cost of that is when the government says we all gotta hold hands here until the world we're safe, and so that means you're all taking a bailout. I think that's okay to be dragooned to that kind of thing. It's like a license to operate a nuclear power plant. Like sometimes you have to perform a government.
The problem is it induces sloppy behavior in a dynamic model. That is, you're trying to fix the thing at the back end by concealing quality differences. In that world, why would you want to make yourself a decent bank when the problem comes, you're going to have to bear the same sanctions as everybody else? Now, what you really have to do is to tell people, we're going to have two universes. You could have the mollycoddle units with a lot of backing and government and restrictions, or you could go into the the table stakes poker game, but you don't want to essentially have a situation in which you bail people out from a table stakes game because at that particular point they won't take it. So the TCF Bank in that model actually got hurt by what was going on because they couldn't differentiate themselves, and that's a real social cost, particularly if you're worried about long-term dynamic stability. That's the argument on the other side.
Right. I mean, I think in an emergency, sometimes these kinds of things may have to happen, but you're right. I mean, that is a concern.
I think it was counterproductive also, which is
to make everybody.
Yeah, and that what we need to do is distinguish that basically there were only a handful of banks that were in really bad shape, and we didn't make the bad banks look good. We made all the hundreds of other good banks look bad, and so basically they cratered the whole system. At that point, that's what Richard Kovacevich says in his book. As he warned them, he said this isn't going to stabilize markets, and in fact, that the TARP is what seems to have caused the panic and the downward spiral. Not the markets have stabilized after Lehman collapsed.
There we disagree.
We're going to disagree on this.
It's the timing, yeah. And it wasn't until basically they said, now's the time to panic, that everybody panicked. And Richard Kovacevic and John Allison both said, this isn't going to work. It's not going to stabilize the markets. We don't need the money. And to add to Richard's point, Wells Fargo lost, Kovacevic says, we lost 25% of our market share because we weren't willing to make those loans. And then we came back around and they basically said, all right, now you've lost 25% of your market share by lending responsibly. Now we're going to throw you in the soup with all the bad banks. So, I mean, you could be right, but I'm not persuaded by the evidence that forcing all the banks, including the solvent banks, to take the money that only a handful of bad banks needed actually stabilized the system, as opposed to making the good banks look bad and didn't make the bad banks look good, based on my reading of the data.
Any reaction from?
We might agree to disagree.
Can I just make
always
one?
has the last word.
I always want the last word. Look, it's also important in another sense, if you actually make the selective, then in fact, the fact that you're giving the bailout to a weak bank actually has information for it. And so the weak banks that get the bailouts now look stronger, and you can do a much better job stabilizing the market by targeted relief than you can by the other. Because what these government guys said was, if we target the relief in this way, we'll show that the banks were bad. But there's a second half to the sentence, which is, if we target the relief, afterwards they will know they are better. And so at that point, what you're doing is you're using money that gives information, and in the other sense, you're giving money that obscures it. That is the last word.
I did promise that a discussion of financial crises at 9 a.m. would be an exciting one, even without Richard's interventions, I think so. But with Richard's especially, thank you all to the panelists and to all of you for being here. Thank you.